This week's edition of NJBIA's Minding Your Business is brought to you in part by AT&T, helping family, friends, and neighbors connect in meaningful ways every day. From the first phone call 140 years ago to mobile video streaming today, AT&T innovates to improve lives. New Jersey's community colleges aligning education to build an innovative workforce. Find out how your business can join and benefit at njpathways.org. And by New Jersey Business Magazine, providing the critical information needs for New Jersey's business community for more than 65 years.
Welcome to NJBIA's Minding Your Business. I'm Bob Considine. Well, the highest inflation in 40 years is certainly having a significant impact on the economy and financial markets. So what's an investor to do? Here to discuss some recommendations and the current climate are a pair of very knowledgeable managing principals from Peapack Private Wealth Management. They are Chief Investment Officer John E. Kramer and Head of Investment Strategy Jeffrey Fisher. Gentlemen, thank you so much for being here.
Our pleasure.
All right, so when we talk about Peapack Private Wealth Management, this is the largest New Jersey headquartered bank-owned trust company. What do you folks offer and what makes you unique from other investment and financial planning firms?
That primarily the breadth of services that we offer, from financial planning, investment services, wealth transfer strategies, tax planning, make us unique. But also I think our people, we're very experienced. For example, on the investment side, the average length of experience is over 25 years.
No kidding. Wow.
So we're very experienced as a group. But I think the other element is the value-added component that we place in regard to how we treat our clients.
Right.
Is very important. So we put our clients before everything else as a fiduciary.
And part of Peapack Gladstone Bank, correct?
That's correct.
Yeah, and they've been around for 101 years?
101 years.
That's amazing. That's amazing.
1921.
Wow, amazing. So let's talk about the economy. Let's go right into it. Inflation, it's been here all year long. I guess the first question I want to ask is, how did we get here? What were the factors that got us here in the first place?
Yeah, I'll take that. So this really dates back to the pandemic in early 2020 and the response by both fiscal and monetary authorities to try to deal with lockdowns that have the potential to bring the economy full stop to a depression. So we saw incredible efforts by the Federal Reserve in terms of bringing interest rates to zero, flooding bond markets with purchases of $120 billion a month of securities, and putting other lending facilities in place to assure market liquidity. Congress, for its part, put several bills forth that put the better part of $5 to $6 trillion into consumers, businesses, state and local governments, so on and so forth, all of which had the effect of stimulating enormous demand at a time when supply couldn't meet that demand. So that created this effect of too much money chasing after too few goods, and the result of that is inflation.
Right. So what do you think we'll need more rate changes to curb inflation?
So we're at 8.5% CPI. It's the first month that has come down from a long series up.
Right.
The Fed has a lot of work still to do.
And are we talking about peaked inflation? Is that what we're talking about? Has it peaked, I guess, is what I'm asking.
Good question. 1 month doesn't make a trend.
Right.
But we're somewhat optimistic that we may have seen the worst of it. We could get another bad reading, but in general, it appears as if we're likely to have seen the peak. Oil prices have started to come down. Yeah. Other commodity prices as well. So somewhat optimistic on that front, I guess, but from a very lofty level still.
You know, Bob, I think that as I think about it, we very well may have peaked, but that is not the real relevant element. The relevant element is really where inflation settles down.
Right.
And we're many months away from actually knowing where that's going to be.
Right. So I guess that begs the question. I mean, are we in a recession now? I mean, do you guys observe it that way? Are we getting there?
It's a tough question, and it depends who you ask. But what we would say is that the Fed has a high wire act that it's in the midst of, trying to slow the economy enough to bring that inflation down from very unacceptable levels without pushing the economy into a recession. The way the official tallying of recessions goes, we don't know yet because it generally relies on a broad weakness in the economy. We have not seen that yet in the labor market. So I think it's early to declare that, but certainly should be on watch for it.
Okay.
So we have had 2 negative GDP prints, but I don't think we're necessarily in a recession at this point.
Okay.
If you still look at, and there's been some significant slowing in aggregate demand, but it hasn't been enough to really, I think, to declare it a recession.
Jeff, were you talking about, when we were talking about beating inflation, is this what we refer to as a soft landing? Beating inflation without entering a recession?
That's the proverbial soft
Is there
landing.
a precedent for that? Has this ever happened before?
Yeah, it's happened, to put it in context, in my career, it's only happened once.
Okay.
So it doesn't happen very often.
Right.
The last time was 1994, to give you a sense of it.
Ah.
So it's been a long time.
Yeah, no, you were not doing this enough. You just started a few years ago, right? Let's talk about the impact on corporations and consumers. What impact has high inflation had on consumers? What are you guys seeing?
Well, I think it's, consumers have been remarkably resilient in this whole thing, but aggregate savings was significant through the pandemic for a lot of different reasons. There are a lot of employees that weren't impacted by the pandemic and were able to save money through the whole process.
Right.
And in aggregate, I think the consumer had about $2 trillion in excess savings that they're at this point working through.
Right.
So we've seen about 5 consecutive months of that kind of runoff.
Right.
So it really hasn't had a huge impact, but there's been a stratification in terms of the consumer. So the lower income consumers are much more impacted.
Right.
More of their disposable income goes toward gas and food and things like that. That have been a challenge for them.
Right. What do you look at for, like, do you monitor like discretionary spending of consumers? And what are the barometers of that? What are you looking at to determine that?
Yeah, so one of the things we're seeing is that there's an enormous increase in consumer borrowing on credit cards.
Oh, yeah, here we go.
So that would suggest that, again, with the stratification that John just talked about, that consumers at the lower end are beginning to struggle. And the other thing we see is that discretionary spending falls off when more of your budget has to cover basics.
Yeah, I feel like we've seen this movie before. What about corporate earnings? Relatively solid in the second quarter. Have corporations been impacted by inflation at all?
I would say the answer is yes, but they're not all handling it with equal aplomb.
Okay,
So,
that's interesting.
as we saw earnings come in over the course of the last 5 or 6 weeks, on average, on balance, they have come in strong and above expectations, but we're seeing wide dispersion even within industries, never mind across industries. So a company like Home Depot reported a really strong number last week and Lowe's didn't.
That's very interesting.
Yep, we saw that with Walmart and Target this week. So
That's incredible.
companies are not necessarily all faring equally well through this.
Oh, John?
So in aggregate, we're looking at earnings that are just now beginning to slide. So there's 2 elements to it when we look at corporate earnings reports. The first is actually the report itself. The second is really what companies are saying about the future. And the future expectations are starting to come down. So we're starting to see that, we're starting to feel that, but it's just relatively modest at this point.
Right. I want to just talk about the financial markets. They've been extremely volatile. What problems does that cause? I know there's something you guys wanted to discuss was a yield curve, right? This is currently inverted, and I guess that doesn't happen every day. First of all, what is a yield curve?
So yield curve essentially says what are all the maturities of bonds from very short term, 30 days, 60 days out through 30 years.
Right.
And in a normal environment, you would see the longer the term of the bond, the higher the interest rate.
Got it.
An inversion is when the short end rises above the longer end, and that's the phenomenon.
Got it.
you're
Understood.
referring to.
Okay. So equity markets, they dropped into a bear market, right? What caused that?
So we would say that the single biggest driver of that has been higher interest rates.
Yeah.
Higher interest rates mean that the value of future earnings for corporations will be lower.
Right.
And so we've seen a repricing of stocks to reflect a higher interest rate environment. I just add that what we haven't seen yet is a significant reduction in earnings expectations that would come with a recession if we were to get it.
Okay. Very good.
Yeah, it's really, I think, kind of a two-shoe process. The first shoe is really kind of the revaluation because of interest rates. The 10-year Treasury doubled, went from 150 to over 3%.
Wow.
About 3% today.
Mm-hmm.
And that's really kind of the revaluation piece of it. And as Jess mentioned, the earnings piece is the next potential shoe to drop.
So is it a fair question to ask if the bear market is over?
That's a very good question.
What do you think? Putting you on the spot.
Well, I was reading some research today that suggested that anytime you have a retrenchment of more than half of the drop, and we have had that with the recent rally in equities, that typically there's more upside than downside over the next 12 months.
Right.
However, this is an elongated process, and it's going to take a while for the Fed to get inflation under control. They've just gotten interest rates, the Fed funds rate, to neutral, long-term neutral, which is about 2.5%. They're going to have to be more restrictive than that to actually get inflation under control.
Okay.
It's going to take a while. Not sure exactly how long that process is going to take, but in all likelihood, that could play out over many months and even into next year, where we may see a little bit more volatility going forward.
Okay. Let's talk about recommendation for clients a little bit. What advice? I don't know if your clients are feeling skittish. They're probably not. They're seeing the volatility of the climate. They're probably not getting back as much on their investments, or at least they don't think they are. What do you tell them?
Well, several things, and it starts with reminding ourselves as well as our clients that we're long-term investors, and we're not trying to trade through each little move and nuance in the markets. So long-term focus, remembering what clients' goals and objectives are, and the strategy we and they have devised together has that long-term focus.
Right.
The other thing we would say is that in a more challenging environment like this, owning quality instruments, whether they're in the stock or bond markets, will create a smoother landing and get you through this difficult period with a lot less aggro.
John, do you want to add anything to that?
No, I think Jeff is spot on. I think you got to, one of the things that we do is really work with our clients to establish long-term goals.
Right.
The investment piece is a portion of that, and we need to remind them in volatile markets that they need to be focused on what they're really investing for.
Yeah, sometimes I've heard, sometimes these opportunities, new opportunities are created through recessions or a market pullback. Is that the case for real?
I think so. As you kind of look at, we talked about assets repricing, and that's very much the case. So assets have repriced, so that we're able to access investments today that weren't available to us 18 months, 2 years ago, from a valuation standpoint. So we can upgrade the quality of a client's portfolio in terms of the type of companies that they own at more attractive valuations. So there are opportunities that are being created through this whole process.
Okay, it's very interesting. Are there specific go-to areas where to invest in times during the recession? I've often heard, and I wrote this down, defensive stocks or dividend stocks. Another thing you got folks should be looking at?
We do think defensive areas of the market will hold up better in a downturn, and those typically are things like consumer staples, healthcare, utilities, and that has been the case this year so far.
Okay. Is now a time for investors to rethink their portfolio positioning, and how can Peapack Private Wealth Management help with that?
Please. No.
It's always a good time to take a fresh look at how you're invested. Volatile markets like this test clients' risk tolerance, and it's a great opportunity to reassess and make sure that the portfolio that's been constructed is one that they can and will see through the long term.
And oftentimes, is there need for change? I mean, do you find that this is a good opportunity to find change that you need to do?
Well, like you're just talking about, Bob, there's opportunities that are being created. For example, in the small cap area, which we haven't seen in a while, and valuations over the last 3-4 years, small cap has become much more attractive. And we know that when you tend to come out of periods like this, they tend to outperform for a while. So there's some nimbleness that goes on in terms of reconstructing portfolios during this period.
Right.
I'd also say that bonds have become more attractive for absolute higher yields.
Very good. In closing, there's obviously, these are dynamic times. How important is it for your firm to keep regular communications with your client? I saw your website, First of all, if you're not a client, you should go check it out because it's amazing. I wrote this stuff down. It's they have weekly economic and market recaps, planning newsletter, quarterly investment outlooks, and the list goes on.
Right.
So, but you guys seem to be really engaged with your clientele. How important is that right now?
It's absolutely critical. There are scary headlines out there, and
Definitely.
we don't want our clients reacting to them or misinterpret them. We'd rather be walking by their side and helping them understand how we and they will get through periods like this.
What do you think, John?
No, I think it's true. We need to be very responsive to our clients, and especially in these volatile markets, and also help them kind of navigate and stay focused on what their objectives are.
All right. Well, this has been a great education. Folks want to check it out. They want to go to peapackprivate.com to get you started. You guys have been great. Jeffrey Fisher, John Kramer, thank you so much for being here.
Thank you, Bob.
Thanks,
I'll
Bob.
be back right after these words.
Well, I have never lost that many balls before.
That was bad timing on those spam calls.
Yeah, well, that's why my club slipped out of my hands. Oh, and I don't normally drive the golf cart into the water in a fit of rage because I bogeyed.
Nick,
It's a low point for me.
with AT&T, you get built-in protection to block those calls.
Well, clearly I need that.
Well, you're getting better.
AT&T helps push what's possible, like making Nick Jonas better at golf.
You really think I'm getting better?
Welcome back to NJBIA's Mind Your Business. I'm Bob Considine. Well, NJBIA has updated its 2022 Indicators of Innovation report, which details how New Jersey's innovation economy compares to other states in the region. Here to discuss some of the very interesting findings in that report is NJBIA Director of Economic Policy Research, Kyle Sullender. Kyle, thank you so much for being back on the show.
Thanks for having me, Bob.
And I have to say, this report, the 2022 Indications of Innovation report, it is so well done. You know, I think people, when they hear innovation, they might zone out a little bit. They might think it's complicated. This is incredibly accessible, and it's a great credit to you to how thorough and well done this is done.
Appreciate that. Absolutely.
All right, so let's talk about it. Let's do an overview before we get into the 12 indicators. Overall, this is on capital, talent, and business you were measuring. How did New Jersey fare?
So this is the third time NJBIA has done this report. Started in 2019. We changed things up a little bit for 2020 and then tried to do it the same way in 2022 so we could really draw that time comparison. We measure 7 different states, all within our region, our direct regional competitors. New Jersey tied for 5th with Connecticut, lost a little bit of ground to Maryland, and then continued to trail those guides that lead the pack, like Massachusetts and New York.
Yeah, the big boys.
One point we like to make, though, is even though New Jersey looks like it slipped a little bit, we actually have a couple of reasons to be optimistic as we move forward. When you look at the recommendations that NJBIA made back in 2020, the last time we did this report, quite a few of them have seen progress. The governor, the legislature, other governmental agencies have taken action in areas that NJBIA recommended, and you wouldn't expect to see results stemming from those recommendations right away. Some of them were only enacted within the last 6 to 8 months. So although New Jersey did slip a little, we have reasons to be optimistic about where we're headed.
Yeah, so it takes a little while to take root. So for the next report, we expect much better things.
We would hope to be better than where we are.
Okay, so I'll start off with the first indicator. This was under capital. I mentioned this is, you broke it down to capital, talent, and business. Under capital, venture capital, assets under management, how did New Jersey fare?
New Jersey was towards the bottom. I think we ranked fifth overall. Assets under management's an interesting measurement. It's a little different than just venture capital activity. So there you might be seeing venture capital firms from other states investing in New Jersey. New Jersey actually did very well in that regard during the pandemic. There was a venture capital boom. Assets under management, though, measuring the amount of money that New Jersey-based venture capital firms hold, haven't quite seen the same growth.
Yeah, and New York and Massachusetts, again, right at the top, the big boys there. I want to go over indicator 2. You know, this is an important one. I'm going to read what these acronyms mean. So it's basically the Small Business Innovation Research and the Small Business Technology Transfer Programs. These are obligations that each state receives. And again, it looks like New Jersey placed 5th here. Why are these? Why is this indicator important?
These are federal funds that are directed to high-growth organizations, high-growth projects. They make a lot of that research and development possible. And so to see New Jersey lacking in that department, again, you expect Massachusetts and New York to kind of pace everybody else. California isn't part of this study. You would expect them to pace everybody else. I think one area we really want to look to here is that growth. And I don't know that New Jersey is seeing the same growth based on the data that we measured that some other states are in the region.
Got it. Indicator 3, state R&D expenditures. I look at New York and there's this big bag of money,
Yeah.
$453.8 million. And New Jersey was kind of towards the end of the pack here. But none of the states cumulatively don't compare well with New York.
New York, I think the graphic we have shows, every state totaled up doesn't measure.
Yeah.
It doesn't match New York.
Right.
This is another area where, all of these statistics have caveats. Every data point has something to mention. Research and development obligations can vary year to year. It doesn't include things like investments in research universities. So if the state gives Rutgers money to go out and do some studying, that wouldn't show up here. But again, it's an area where when you look at the trajectory of those funds over the last 10 years, New Jersey doesn't quite keep pace with its neighbors in terms of actually growing those outlays.
No, that's very interesting. And the last one on capital, last indicator, number 4, National Science Foundation award totals. It looks like New Jersey got 5th as well on this one out of the 7 states. Why is this indicator important?
Again, federal funding towards projects like this are extremely important to drive innovation, to drive innovative companies and individuals. It comes down to the institutions in the state. Again, this is one that can be a little difficult to increase. It's a little drawn in unless you can start to attract more of those folks into the state and do different things that the state is working on to help them attract that funding themselves. So there are levers there. I think we address some of them in our recommendations.
Right.
To hopefully move that needle forward as we
Any
go.
particular recommendation you want to bring up within the capital section?
One in particular was increasing funding to the Commission on Science, Innovation, and Technology. This is a state agency. There have been some increases in recent budgets. We'd like to see that continue as we move forward. That commission is focused on helping to increase these federal programs and the funding that gets directed towards programs in New Jersey.
Okay, very good. Now we're going to turn over to the section, the talent section of Kyle's report. Number of institutions ranked in the top 100. This is under U.S. News, World and Report. U.S. News and World Report, I should say. New York and Massachusetts, 11 and 9.
Yeah.
And New Jersey has 3. How important is this in the grand scheme?
It is important. I don't want to overstate its importance because obviously New Jersey's not going to just sprout up 6 new universities overnight.
Yeah.
The rankings change year to year. So one year, one school will be number 90. The next year, they're 101, and then they come back and forth. But those are the institutions that attract the best and the brightest. Those are the institutions that receive the most in those federal funds.
Yeah.
And so it's not so much an indictment on the state to not have as many as New
Right.
York and Massachusetts, but it is a signal about how much capacity you have to attract some of that capital and the individuals.
Yeah, I think I read in a report like Massachusetts has 9. Geographically, most of them are right in the hub of Boston, right?
Yeah, it's either a 1 mile radius or a couple of mile radius that they're all right there together. That's when we start to talk about innovation ecosystems, innovation hubs,
Right.
And the collaboration starts to play an even larger role when they're able to share technology and resources so closely.
Yeah, a little bit more challenging for New Jersey to have that geographically to pull that off.
A lot more disbursement, but also a relatively small state. So there's still a lot of opportunity there geographically for
Right.
cooperation between our institutions as well.
All right. Indicator number 6. This is a big one, folks. Net migration of first-time degree seeking undergraduates. We look at this graphic and we show that 27,000 and change undergraduates are basically seeking their first-time degree elsewhere, whereas the rest of the region isn't. You got Maryland and Connecticut also on the minus side, but other states are on the positive side. This is a big deal for New Jersey, is it not?
Yeah, this is one of 2 places in the report that we really highlight where New Jersey isn't just an outlier regionally, but nationally as well.
Yeah.
So what we're looking at here are statistics measured by the National Center for Education Statistics, measuring how many individuals from New Jersey go to school out of state and how many out-of-state students come to New Jersey for university. As you mentioned, more than 27,000 more students leave than come in.
Right.
That is a loss of talent. Obviously, New Jersey spends a lot of money on K-12 education, so those are some of our best and brightest going elsewhere. But the other concern is that those students will decide to live, work, and innovate in the states where they end up going to college instead of doing it here in New Jersey.
I think investment is a key word here. So much money goes, tax dollars goes into K-12 education, and to not get the return on investment is a pretty damaging thing. Indicator 7, percentage of population with a graduate or professional degree. New Jersey, again, 5th here, but it doesn't look like a huge disparity of percentages within the states.
No, not a huge disparity, and certainly New Jersey's performance in the talent indicators is better than it is in the capital indicators. And so even when we talk about that out-migration, the talent we have here is great, and there is a capacity in New Jersey to take advantage of that talent that already exists.
Right.
The recommendations that we outline get to how to take advantage of that talent a little bit better, and obviously with the out-migration that we mentioned, we'd like to see even more of those students stay to study and work in New Jersey.
Okay, very good. Indicator number 8, again, this is the last one under talent. Rate of new entrepreneurs. New Jersey faring pretty well here, 2nd in the region, just behind New York. How big of a deal is this one?
It's a very big deal. This is the percentage of the population that starts a new business and has that business succeed. And so there is a talent in New Jersey that's ready to take that step. It's ready to hit the entrepreneurial mindset.
Yeah.
And it's about creating an environment that's conducive to that, allows them to grow, to innovate, and to continue to build that capacity.
Great. Good on New Jersey on that one. All right, now we'll turn to the section of business in the 2022 Indicators of Innovation report. Number of patents granted. New Jersey is 4th, right in the middle of the pack here. Why is patent granted an important detail here?
This is a signifier of part of that entrepreneurial mindset, part of that business climate. But what it really gets to is, can individuals with innovative ideas in your state bring that idea kind of to that next step, to actualize it and begin to commercialize it?
Okay. Next one. This one, very interesting. Rate of new employer business actualization. New Jersey looks like they were tied for 4th with Connecticut, ironically enough. So why is this? What does this actually measure, this rate?
The rate of new business actualization tries to measure, of those new businesses that get created within a set time frame, how many then move on to have a payroll. So how many go from, I have an idea, I'm going to start a business, to, I now have the capacity to employ others in my business, which is usually a signifier of not only success, but growth and of future growth capacity as we look forward.
All right. Now we'll turn to net business growth. I was fascinated by this one, Kyle. New Jersey, number 1 by a long shot, 4,516 in the net business growth number. And we're basically destroying the competition here. Why is New Jersey doing so well here?
So this is an interesting indicator. So it varies year to year. This is one where you'll see a lot of variation from one year to one year. There was a little bit of strangeness within the statistics. We actually had to omit a data year because I think it was Connecticut, I don't have them in front of me, that saw this crazy net business growth. When we looked into it, it was a recoding of certain jobs. It looked like business growth, but it wasn't. But the data year that we have on file was strong for New Jersey. I think it's useful here to also look at the average. New Jersey performs pretty well on average when you look at it. Not quite the disparity that you see in the report, though.
And we're up to the last indicator, Kyle. We have about a minute left, a little less than a minute here. Business tax climate. We talk about this all the time here for years. And New Jersey is last in the region and last nationally. I know you didn't weight these particular indicators, but how important is this one?
It's obviously important, right? We don't weight the indicators. We don't make any attempt to say which are more important than others.
Right.
It's not a surprise to anybody watching your show that New Jersey places last here. Again, not only regionally, but nationally as well.
Yeah.
We use the Tax Foundation's Business Climate Index as a proxy here for a whole number of tax measurements. This is obviously important. This is the ability that businesses have to develop and grow in New Jersey, and the ease of that and their ability to do it in the future. So this is an area where we say you may not have to make radical changes, right? Little changes can take you from 50th to 48th to 47th, and that may place you a little bit higher on these rankings.
All right. Kyle, again, it's the 2022 Indicators of Innovation report. You can, we'll have the address. You can go look at it on the screen. Great job, Kyle.
Thank you.
All right, and thank you for joining us on NJBIA's Minding Business. We'll see you next time.